Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. equity market and sector performance, June 9, 2026. This video presents a direct informational narration of the source document, so let's get into it. Our agenda today briefly covers market volatility, geopolitical catalysts, institutional outlook, optical communications and AI, specific equity performance, and finally, software sector weakness. Okay, starting off, U.S. equities face some pretty heavy intraday selling pressure on Tuesday, June 9th. The Nasdaq Composite actually took a sharp 3.6% decline early on, which was largely driven by algorithmic trading creating a cascading effect. But then, a deep V-shaped reversal happened in the afternoon, allowing the indices to recover the vast majority of those intraday losses. Ultimately, the S&P 500 closed with just a slight decline of 0.26%, the Nasdaq fell by 0.97%, and the Dow Jones Industrial Average successfully managed to turn positive. That being said, sectors like software, AI servers, consumer electronics, and auto manufacturing definitely sustained some significant downward pressure throughout the session. Looking at volatility, the VIX surged intraday to 23, marking its highest level since April 7th, before pulling back below 20. What this movement tells us is that the market isn't really entering a definitive bear phase. Rather, with the prior upward momentum cooling off, institutions are just rapidly establishing hedging positions, which naturally pushes the VIX higher. Early in the session, we saw the S&P 500 attempt a rebound, touching its monthly moving average right around 7,483 points. However, with impending CPI data creating severe risk aversion, the index couldn't maintain its momentum and trended lower. Institutions were actively using the prior session's index bounds to purchase put options at spot prices for downside protection, rather than stepping in to buy calls. Because of that structural hedging, the downward move wasn't entirely surprising, although, the actual velocity of the sell-off remained quite notable. Moving on to Section 2, Geopolitical Tensions and Macro Catalysts. The sell-off accelerated due to two primary geopolitical catalysts. First, the Israeli military chief indicated preparations for stronger, more severe attacks on Iran, readiness to resume direct combat, and increase strikes against Hezbollah. Then, subsequently, a post from Donald Trump pointed to a military report stating that Iran shot down a U.S. military helicopter over the Strait of Hormuz. Both pilots were reported safe, but the statement really emphasized a requisite U.S. response. This starkly contradicted the earlier expectations of a nuclear peace agreement within days. Following these developments, market losses expanded. Breaking the 30-day moving average at 7,400 points triggered a fresh wave of algorithmic and panic selling. Liquidity fractured at the 7,300 put wall, pushing the index to an intraday low of 7,238 before finally halting. The index then pulled back near its 30-day moving average, forming a daily doji candlestick with a long lower shadow, which was driven by a mix of short covering and dip buying. Now, the recent market decline has partially released the upcoming CPI risks. Consensus forecasts highlighted by Nick Timiraos suggest headline CPI might run hot due to rising oil prices, but the critical core data is expected to remain mild. If this holds true, it could actually signal a short-term bottom as those negative catalysts become exhausted. This setup is particularly relevant right now with the SpaceX IPO scheduled for Friday. Deep involvement from major Wall Street institutions, notably Goldman Sachs and Morgan Stanley, provides a structural incentive to prevent severe market degradation during this listing window. Essentially, the recent contraction in valuations and sentiment effectively clears the path for SpaceX. Following consecutive days of declines, indices may attempt to retest the monthly or 10-day moving averages, making excessive bearishness unwarranted, with that 7,238 mark likely acting as a short-term low. However, getting a direct V-shaped reversal back to the previous high of 7,600 remains difficult. Section 3, Institutional Outlook and Central Banks. Looking forward, the Bank of Japan is widely expected to hike rates. A Nikkei report indicated an expected hike to 1% in June, with potential further action following in October. Concurrently, the June 17th FOMC meeting, guided by Warsh, remains the most critical event of the month. Unless the CPI data broadly misses expectations to completely shatter rate hike assumptions and reopen rate cut possibilities, a cautious approach focusing on tactical rebounds is advised. Institutional posturing reflects this caution. JP Morgan's trading desk downgraded its near-term U.S. equity rating to tactical caution, warning of continued short-term volatility and persistent selling pressure in technology stocks. The firm advised that accumulating positions in batches over the current and following week is more reasonable, implying potential further downside testing. Wells Fargo also noted that while the overall market's ascent will slow noticeably, the broader upward trend maintains structural viability. Over in the energy sector, U.S. Energy Secretary Chris Wright confirmed that oil transport activities in the Strait of Hormuz have seen a notable recovery and will continue to grow. This resulting decline in oil prices suppressed inflation expectations, which then prompted a pullback in the 10-year Treasury yield from its highs. That pullback provided crucial support for the broader market's intraday reversal. Shifting gears to semiconductors, the Philadelphia Semiconductor Index closed down 1.93%. Its intraday lower shadow only briefly touched the 30-day moving average before rebounding, demonstrating quite a bit more resilience compared to the S&P 500 and Nasdaq, which approached their 50-day moving averages. What this indicates is that the semiconductor sector retains thicker margins and an overall long bias positioning. Section 4 covers optical communication and AI sectors. Within optical communications, CHOR experienced the steepest decline. This followed a report from research firm SemiAnalysis regarding 800 VDC pushouts and co-packaged optics delays, citing technological bottlenecks and likely delivery delays. Now, while this thesis had already circulated 2 weeks prior and was previously attributed to slow U.S. power grid updates, it was utilized as a catalyst for institutional distribution, given the sector's extreme optimism and crowded positioning at historical highs. Other optical communication stocks naturally followed lower. AAOI plummeted over 17%, printing a long bearish candle that tested its 50-day moving average, which is a critical support level that hasn't been breached since the beginning of the year. In the broader AI landscape, OpenAI has reportedly submitted a confidential IPO application following Anthropic as the next major AI entity pursuing a public listing, with a potential timeline pointing to September. On the infrastructure side, APLD surged over 13% initially before giving back most gains due to broader market drag. The company signed a 15-year lease agreement expected to generate approximately $5.2 billion in revenue. The agreement covers 210 megawatts of computing capacity at its Delta Forge 2 AI factory. This marks its third long-term lease with the same investment-grade hyperscaler, which is estimated to be Microsoft, Google, or Amazon AWS. Conversely, CRWV has underperformed peers since last July. 3 co-founders cashed out over $2.3 billion, reducing their stakes by nearly a quarter, while institutional shareholder Magnetar sold $5.5 billion, halving its position. Despite massive insider selling, $25 billion in debt, and a lack of quarterly profitability, Wall Street analysts largely maintain a bullish consensus on the stock. Moving to Section 5, specific equity performance metrics. In large-cap technology, Qualcomm initially rose nearly 3% pre-market after receiving a public endorsement from NVIDIA CEO Jensen Huang, but then it experienced a deep intraday V-shape and closed down 5.67%. NVIDIA itself saw intraday pressure, breaking its 50-day moving average to touch the $200 level, which cleared out stop-loss orders before finally reversing higher. In the consumer and gaming sectors, DraftKings surged over 11% on heavy volume, clearing its half-year moving average on capital positioning ahead of the World Cup. Anheuser-Busch InBev also gapped up, aligning with the same sporting catalyst. Apple, meanwhile, acted as a major drag on the broader market throughout the session, though it formed a daily doji with a lower shadow, suggesting potential for an oversold technical rebound. Looking at hardware, Micron Technology opened near 5% higher after Goldman Sachs raised its target price to $900, while maintaining a neutral rating, citing a positive third-quarter outlook. The stock closed lower with the market but bounced off its monthly moving average ahead of its June 24th earnings report. Jabel surged over 6% pre-market, as commentary on the X platform highlighted the underpriced valuation of its 1.6T LRRO pluggable optical module business. In the space sector, Redwire fell over 15% after initiating a $500 million ATM equity offering, capitalizing on the broader space theme. Destiny Tech 100 retraced heavily to its starting point, shedding the premium built around the upcoming SpaceX listing, as capital waits for direct access. Finally, Section 6, Software Sector Weakness. A stark divergence has emerged between hardware and software. While most AI hardware names rebounded, the software sector really faltered. Microsoft recorded its 7th consecutive daily decline after falling from its yearly moving average, acting exceptionally weak regardless of the broader market's directional movements. Year-to-date, Microsoft is down 16%, significantly underperforming Meta and Tesla, which have recorded declines of 11%, making it the worst performer among the megacaps. Given the duration and depth of the current sell-off, technical conditions suggest the stock may experience a mechanical rebound. But that leaves us with a pivotal question. With software severely underperforming hardware year-to-date, when will institutional capital rotate back into mega-cap software equities? It's something to keep a close eye on as the market dynamics shift.